Hey everyone, I'm Evelyn, and today is June 18th, 2026. Right now, Wall Street is tearing itself apart over one massive question. Are we trapped in a giant AI bubble? Even Big Short legend Michael Burry sounded the alarm last month, warning that today's tech hype closely mirrors the 2000.com crash. But while institutional investors stare at boring spreadsheets, a viral post on Reddit's r/stocks just dropped a brilliant, completely unhinged perspective. This guy argued that the AI bubble is nowhere near bursting for one specific reason. He said, "Just look at AI adult content. The quality is still absolutely terrible." Now, hear me out before you laugh this off as a joke. In the world of tech adoption and venture capital, this bizarre angle is actually a masterclass in market psychology. Why should serious investors care about the adult entertainment industry? Because for the last 50 years, it has been the ultimate hidden kingmaker for consumer tech. Think back to the historic VHS versus Betamax war. Sony's technically superior Betamax lost entirely because JVC allowed adult content on its VHS platform. From early online credit card processing to high-definition video streaming, the adult sector has always been the first major investor and the harshest tester. Its business model is brutally simple. Users have raw demand. They pay real cash up front, and they are incredibly picky about user experience. If a cutting-edge technology is truly mature, fully commercialized, and pushed to its absolute limit, the adult industry is always the very first place where it looks completely flawless. But look at AI-generated content today. We are still regularly seeing people with six fingers, warped skin textures, and that creepy, uncanny valley vibe. This proves we are still in the clunky, dial-up internet phase of generative AI. If the most easily monetized industry on Earth can't make the tech perfect yet, the general public is nowhere near peak irrational exuberance. Interestingly, Wall Street's hardest data actually backs up this exact timeline. Goldman Sachs reports that tech giants are dropping a staggering $765 billion on AI capital expenditure this year alone. They are on track to spend $7.6 trillion over the next few years. This isn't blind FOMO. This is the largest infrastructure bet in human history, and we are still just building the global highways. Of course, cautious value investors are screaming that this is Cisco all over again. Back in 2000, Cisco sold the routers for the internet, hit a massive valuation, and then crashed into oblivion when the bubble burst. Today, Nvidia's valuation has skyrocketed to $4.3 trillion, making it look like history repeating itself. But if you actually run the numbers, the math tells a completely different story. Cisco peaked at a price-to-earnings ratio over 100, selling to sketchy.com startups that had zero revenue. Nvidia in 2026 is raking in $215.9 billion in annual revenue, growing at 65%. More importantly, its gross margin is holding above 70%. Nvidia is selling elite hardware to trillion-dollar tech titans who are paying with actual cash piles. The real threat today isn't a total market collapse, but a massive productivity paradox. A recent National Bureau of Economic Research report shows that 90% of companies admit AI hasn't boosted their bottom line yet. We have a huge gap between expensive infrastructure and real-world profitability. OpenAI plans to spend $1.4 trillion on data centers, yet its current revenue is only around $13 billion. This means we won't see a dot-com-style wipeout of the tech giants, who have bulletproof balance sheets. Instead, we will see a brutal cleansing of hyped-up AI startups that can't monetize. So, what do you think about this Reddit theory? Are we building the future or buying an illusion? Let me know below. Drop a like, and I'll see you next time.